Two guys, same $50,000, same day, January 2006. One became a landlord, one bought gold. After year one, the landlord was losing money every single month. After year 5, the gold guy was ahead by $40,000. After year 10, it was too close to call. And after 20 years, one of them had nearly $300,000 more than the other. But the shocking part isn't who won. It's why the loser genuinely believed he was winning for over a decade. And why right now, in 2026, millions of people are about to make the exact same mistake. Meet Cole and Jake, both 30, same city, same salary, $60,000 a year. January 2006. Both just received a $50,000 inheritance. Cole doesn't trust Wall Street. He's watched inflation destroy his parents' savings. He's read enough history to know that gold has outlasted every empire, every currency, every financial crisis ever created. He takes his $50,000 and buys gold. Physical bars. No debt, no tenants, no stress. Checks the price once a month. Gets on with his life. Jake has been watching real estate videos for months. Every single one says the same thing. Passive income. Equity, leverage, generational wealth. He's convinced. He puts his $50,000 as a 20% down payment on a $250,000 rental property. 3 bedrooms, decent neighborhood. Tenant paying $1,800 a month. On paper, Jake clears $470 a month in profit. Cole earns literally zero. Gold just sits there. For exactly 90 days, Jake feels like a genius. Month 4. Jake's HVAC dies. $7,000. Gone. Just like that. No passive income video mentioned this part. Here are Jake's real monthly numbers, because that $470 profit was a fantasy from day one. Mortgage, $1,330 a month. Property taxes, $250. Insurance, $100. Maintenance. Industry standard 1 to 2% of home value annually. On a $250,000 property, that's $200 to $400 every single month, averaged out. Vacancy. National average 6 to 8% per year. Roughly 1 month of zero rent. Property manager. Another $150 to $180 monthly. Real costs, $1,880 to $2,260 a month, against $1,800 in rent. Jake isn't making $470 a month. Jake is losing money every single month. Jake's wife opens the mail, sees the HVAC bill, looks at Jake, doesn't say a word. She doesn't have to. Cole sends a gold bar emoji. Jake doesn't reply. And here's the thing. At this exact moment, Cole is right. Jake is bleeding. The math doesn't lie. But there are 2 types of problems in investing. Problems that heal, and problems that quietly kill you while you're celebrating. Jake has the first kind. Cole has the second. And Cole is too busy sending emojis to notice. Cole is having the time of his life. Inflation fears, global instability, central banks hoarding gold. In 2007 alone, gold jumps 31%. Cole's $50,000 becomes $63,000. Zero effort, zero calls, zero broken HVACs. He's winning, obviously, clearly, undeniably. Except, gold has one fatal flaw that doesn't show up in year 1 or year 2. It shows up slowly, quietly, invisibly. Like a leak inside a wall that you can't see until the ceiling collapses. Gold produces nothing. Not a dollar, not a cent. No rent, no dividends, no interest, no yield. It's a shiny rock that doesn't send you a single check. The only way Cole ever makes money is if someone else is willing to pay more for his rock tomorrow than he paid today. There's no engine underneath, no compounding, no growth, just price, just sentiment. Just whatever the world feels like paying at any given moment. And when the world stops panicking, gold stops moving. From 2012 to 2019, 7 full years. gold went essentially sideways. 7 years of zero income, zero growth, while inflation quietly ate Cole's purchasing power from the inside. Stop. Read this slowly. Someone who bought gold at its peak in 1980 didn't break even until 2008. 28 years. Not underperformed, not struggled, lost for nearly 3 decades. An entire generation held gold, earned nothing, watched inflation eat their savings, and finally broke even, just in time for the 2008 financial crisis to hit. Cole didn't buy in 1980, but he bought near a cyclical high, and high entry points have burned gold investors before, every single time. There's also a tax problem Cole hasn't discovered yet. The IRS classifies gold as a collectible. Maximum federal capital gains rate, 28%, compared to 15 to 20% for almost everything else. Same gain, bigger bill, just because of what the asset is. Cole checks his portfolio one evening in 2016. Gold is basically where it was 5 years ago. He pours himself a drink and tells himself it's a long game. He's right, but not in the way he thinks. Back to Jake. Year 3, 2009. He's still losing sleep, still getting calls, still dealing with difficult tenants. But underneath all that noise, something has started moving that Cole doesn't have. Cole has a gold bar. Jake has a lever. And levers move the world. Rent rises with inflation, roughly 3 to 4% per year. By year 5, Jake's tenant pays $2,000 a month. By year 8, $2,250. Jake's mortgage? Still $1,330. Exactly what it was on day 1. Fixed, locked, permanent. Every single year, the distance between Jake's rising rent and his fixed mortgage gets wider. More of each payment chips away at principal. Equity accelerates. Jake used $50,000 to control a $250,000 asset. 5-to-1 leverage. Every dollar of appreciation works 5 times harder for Jake. When the property gains 3.5%, Jake doesn't earn 3.5% on $50,000. He earns 3.5% on $250,000. That's $8,750 in a single year from appreciation alone on a $50,000 investment. Cole's gold gains 3.5%? That's $1,750. Same percentage, less than a quarter of the actual dollars. By year 5, Jake's property is worth $295,000. Year 10, $345,000. The math has completely flipped, and Cole is still sending memes. Year 10, 2016. Gold peaked hard in 2011, then dropped and went sideways for years. Cole's position, which briefly touched $145,000 at the 2011 peak, has drifted back down to around $107,000. He tells himself it's temporary. He's been telling himself that for 4 years. Jake's property is worth $345,000. Mortgage balance around $195,000. Equity? $150,000, plus roughly $20,000 in cumulative net rental income. Jake's total? $170,000. Cole, $107,000. Jake is ahead by $63,000, and the gap is about to explode. Because in the next 10 years, one of them is going to do something that changes everything. And only one of them will see it coming. Year 20. May 2026. No more memes, just math. And 2026 is a genuinely fascinating moment to run this comparison. Gold is having one of the greatest runs in its entire history. It rose 65% in 2025 alone, its strongest annual performance since 1979. It surged past $5,000 per ounce and hit an all-time high of $5,595 in January 2026. Cole is feeling vindicated. Finally, after 20 years, he might actually be right. But let's run the actual numbers. Jake's property appreciated conservatively at 3.5% annually for 20 years, now worth approximately $490,000. Current 30-year mortgage rates sit at 6.51% as of May 2026. But Jake locked his rate back in 2006. Mortgage balance after 20 years, down to $128,000. Equity, $362,000. Cumulative net rental income after every repair, every vacancy, every tax bill, $60,000 to $100,000. Jake's total position, $420,000 to $460,000. Now Cole. Gold's long-term average, roughly 7.9% per year, is $50,000 after 20 years, about $233,000. No income along the way, no rent checks, just price. And after the 28% collectible tax on gains, Cole's real take-home, $166,000. Jake, $440,000. Cole, $166,000. The gap, nearly $300,000. Same $50,000, same 20 years. And remember, this is gold at all-time highs in 2026. The best gold market in 46 years. And Cole is still $274,000 behind. Imagine what this number looked like in 2015 when gold was flat. Cole closes his portfolio app, sets his phone face down on the table, doesn't send a single emoji. Before you write off gold forever, hear Cole out. Because right now, in May 2026, Cole has a point that's genuinely hard to argue with. Gold has nearly doubled the returns of the S&P 500 over the last 12 months. Central banks are buying it at record pace. Geopolitical uncertainty is everywhere. Anyone who held gold through 2024 and 2025 made serious money with zero effort and zero stress. Cole's instinct wasn't wrong, his allocation was. Real estate is brutally illiquid. Jake can't sell a bathroom when he needs emergency cash. On exit, 5 to 6% in agent commissions plus closing costs. On a $490,000 property that's $25,000 to $35,000 gone before Jake sees a dollar. One property, one neighborhood, one city. If that local economy collapses, Jake's entire net worth goes with it. And the time cost? Thousands of hours over 20 years managing, repairing, screening tenants, losing sleep. Real estate isn't passive income. It's a second job wearing a passive income costume. Cole? 0 hours, 0 calls, 0 stress. Gold's job is real. In 2008, when markets crashed 37%, gold jumped 25%. During COVID, gold surged while everything else collapsed. Right now in 2026, while uncertainty is everywhere, gold is doing exactly what it was designed to do. Cole's mistake wasn't buying gold. Cole's mistake was making gold his entire strategy instead of his protection. Here's what neither of them figured out until it was too late. Gold is a shield. Real estate is a machine. You don't go into battle without a shield. But you can't build wealth with a shield alone. Cole needed 10 to 15% in gold for crisis protection, for the crashes that always come. The rest needed to be working, compounding, earning, building. Jake needed his machine, but one machine in one neighborhood is fragile. A small gold position would have let him sleep through 2008, through COVID, through every panic, without abandoning the engine at exactly the wrong moment. The real wealth isn't built by picking the right asset. It's built by understanding what each asset actually does and putting it exactly where it belongs. Cole's shield was real. Jake's machine was real. Neither of them was wrong about what they chose. They were both wrong about how much they chose. And that one mistake, going all in instead of being intentional, cost Cole nearly $300,000 over 20 years. $50,000. Same day, same city, same starting line. Jake, $440,000. Cole, $166,000. But Jake spent 20 years being a landlord. Cole spent 20 years doing absolutely nothing. Whether that trade is worth it, only you can decide. Here's what we haven't told you yet. There's a third option. No landlord license required, no gold vault needed, no HVAC bills. No 28-year waiting periods. Just one account. And over the same 20 years, it silently outran both Jake and Cole. No phone calls, no repair bills, no sleepless nights. The number is going to make you rethink everything. Subscribe, because that video is next, and you won't want to do the math without watching it first.